Now let's explore the horizontal analysis for the financial statements. Horizontal analysis involves comparing financial data from different periods, typically from the income statement, balance sheet, and the cash flow statement. In the lesson, we will start by looking for the comparison for the income statement. One of the key financial documents used in horizontal analysis. We will compare figures from year to year. We have the year 2024, 2025. We will make comparison for each key items like net sales, gross profit, and net income. Here I split the screen to see both sheets in one screen. So we will start by looking for the net sales. Here we have the income statement for this year. We put it in the right side just to see it if needed. Net sales for its increase from 104 to 145. The growth is 38%, which is considered a very strong growth for the company, reflecting strong revenue growth. This is related to the increase of the sales for this year compared to the previous year. And here we have comparison with the industry standard, which is between 8 to 15%. If the growth is higher than 10%, that means this is a strong revenue growth. If it's between 8 to 15%, that means this is average. If it's below 8%, that means the company needs to have improvement in order to achieve higher growth year over year. Then we compare the data for industry comparison. We have the main three competitors because our company is Sportmax Online, which sells sport equipment. We have compared it with the exporting goods, which has growth between 8 to 10%, food locker, which is 5 to 7%, and Nike, which is 12 to 15%. So our company is really growing fast compared to the last year. So the management for the company, they need to continue showing this higher progress over year. Then we have the gross margin, where we had 47,000 last year. In the year 2025, which become 70,000 with growth of 8%, which is reflecting efficiency, production, and cost management. This improvement in the gross margin percentage indicate that the company is getting more value from sales, potentially by reducing the cost of goods sold or increasing pricing power without significant cost increases. Next, we have gross margin. There is 3% increase, moving from 45 to 48, the good achievement. Then we have operation profit, which moved from 10,000 to 18,000 with an increase of 81%. This is a very huge indicator. That means that the company, they're increasing their operation profit by maximizing their profit and their gross margin. The industry standard is above 15%. That means that is a strong indicator. Here we have 81%. That is a very strong indicator. And if you compare it to the industry, the same thing for all the competitors, their operation profit is increasing 8 to 15%. The company has to continue increasing their revenue in the next year. For the net income, the same thing. So it's increasing by 81% because there is no other income or other cost. Then we have net income, which increased as well by 81%, which reflects strong indicator the company making more profit. Then we have net income percentage, which moves from 8% to 10%, with 31% as growth. This growth reflects not only improved operation efficiency, but also strong financial performance across all areas, signaling a robust profit generation model.